I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. In this video, we're going to take a look into a very controversial topic: why you should not be investing in the S&P 500. Yeah, I know. It's widely known that investing in the S&P using an ETF like State Street SPY or something is supposed to be the safest and best way for retail investors to invest. But I'm gonna tell you in this video, it really isn't. Oh, and before you go crazy in the comments, I should say that the problems with ETFs could be outweighed by the positives, but let's not get ahead of ourselves. The point of this video is giving you a better way to invest than just the S&P 500 and not going all the way to pick individual stocks. So, let's get into it. Now, why would I make a statement like that? Don't invest in the S&P 500. What could possibly get me to say that the good old SPY is not the way to invest for the normal retail passive investor? Well, first we have to go back in time and acknowledge the man, the legend, Jack Bogle, the inventor of the Vanguard funds and the low-cost index fund. By the way, his name is actually John Clifton Bogle, and sadly enough, he passed away a couple of years ago. Jack Bogle has long been irritated about Wall Street making billions and their investors were paying up to 80% of those gains. I'll explain that later in this video, but he was horrified of the way they were mistreating their investors. And as Warren Buffett said so often, Jack has done more for the individual investor than Wall Street ever did.
Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it, Ben Graham even talked about it, but the truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him. And he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds, and we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere.
So why is it that the supposedly best way to invest for the retail investor may not be a good idea? Well, there are some built-in problems with an index fund. It uses a percentage of market cap as a reason to buy a stock. Then we'll buy a stock at the peak of its price and sell at the lowest price. It's just because the company has to be a certain percentage of the fund. Many ETFs are highly traded funds. That means people are buying them on a daily basis and not as they were intended to, as a long-term hold. That was Jack Bogle's idea. But usually people use them as a short-term play, and this creates the problem that all funds have. They have to sell when people want to withdraw, and they have to buy when people pour money in, regardless of what happens in the market. And as Jack Bogle said so many times, trading is the investor's worst enemy and the broker's friend. So Jack's advice is very simple: just don't trade them. But the problem is when people don't listen, and it only takes a certain amount of people to ruin it for the rest of us. But hey, let's be honest, in this day and age, almost all ETFs and stocks are traded on a regular basis. If not by you, then by a lot of traders and gamblers. And one thing you have to remember every time you buy a stock, there is a seller at the other end. So there's always a buyer and a seller. So you have to think, why would he sell? And the other one at the other end would think, why is he buying? And that is why a lot of people trade in and out of stocks actually, just because of the sentiment. Okay, so why do I pick on the S&P 500? It's been around for ages. Well, I have always gone my own way, and when somebody says, everyone should do this, then I will definitely look into how I can do it different. As a concept, I believe in the S&P 500. It's one of the best ETFs to invest in for the long run, and I mean for the long run. I'm also acutely aware that it's not the highest yielding or the best anymore. And as always, it's about risk management, risk tolerance, and your time frame. My day job is in data analysis, so I usually look at the data. And what better way to look into which asset classes have fared the best over time? When we have an idea of which of these have yielded the highest returns over time, we could approximate which ones might do better than others in the future. And yes, I know the argument, past performance doesn't equal future performance. But even though some people say, this time it's different, it really isn't. So let's take a look at those asset classes. Okay, here we see the asset class returns ranging from 2007 until 21. There's no data for 2022 yet, so we're gonna have to make do with those. Let's start at the top here, that in 2007, emerging markets did the best. International stocks were second. Something called an asset allocation portfolio, I will get into that a little bit later, was the third. High grade bonds were doing pretty well, and large cap was kind of in the middle. Remember, this was 2007. It's kind of strange actually, just before the financial crisis. And cash were also good. High yield bonds were okay. Small cap were in minus, and REITs were really not doing very well. But remember, this was in the beginning of the financial crisis, the housing bubble, and that's kind of why. So, emerging markets, well, it looks like when we look across the board where emerging markets have been over time, it's kind of all over the place, top to bottom, more at the bottom than the top. And as I don't time the markets, I will kind of put emerging markets a little bit aside. It's too risky for me, and it's too cyclical. And my time frame is not so far off. I mean, I have a 10-15 year timeline. So emerging markets, no, not for me. Then we look at international stocks. They're moving a little bit more to the middle and are doing okay, more at the top than the bottom, but still kind of all over the place. This one is not for me, as it's too much in the middle, and I would like to have something that's more at the top, something that does better over time. Remember, we're trying to beat the S&P 500. Then we come to the asset allocation portfolio. This one is a portfolio consisting of 15% large cap stocks, 15% international stocks, 10% small cap, 10% emerging market, 10% REIT, and 40% high grade bonds, all annual rebalanced. So it's a kind of very, very conservative portfolio. But as you can see, it's done okay. So not bad. This is kind of the thing we're looking for, just to be a little bit better. Because this one has underperformed the S&P in the last 10 years, and I suggest that this portfolio is only for the very risk-averse person. High-grade bonds, well, almost the same as asset allocation portfolio, although the bonds look a little bit more volatile and spread out. Again, more at the bottom than the top. Large cap stock. This is the S&P 500 index. Well, this one is self-explanatory, and this is the one we want to beat. And as you can see, it's fairly consistent in the high end. This is our index. This is what we want to beat. Cash. Here it's represented in the S&P US Treasury bill. It actually doesn't do much. It's just a kind of store of value. So very uninteresting for this exercise. High yield bonds, it's a high yield bond index. So somebody calls it junk bonds. Well, it's a little bit of a mix of everything. And you would expect a high return, and it actually has done well over time. but still not beating the S&P. Small cap stocks. Well, again, this is the Russell 2000 index. Small cap will usually perform well in good years, but in the last 32 years, the Russell 2000 has only outperformed the S&P 500 by 0.66%. And with a higher volatility and larger drawdowns, no, not for me. At least not as a high percentage of a portfolio. Then we get to the REITs. Over a long period of time, REITs have outperformed everyone else. But as with everything else, the timing is crucial. Like right now. They're not doing so well, just like in 2007 and 8. Remember Jack's words, we're in it for the long haul. And as our timeline is forever, we are considering REITs, but we have to be careful. If we look at the iShares Real Estate ETF, it has outperformed the S&P 500 with 1.5% compounded annual growth in the last 20 years. And if I'm right, we're going to see a lot more in a couple of years. So we're going to need to have a little bit of percentage of REITs in our portfolio. Here I've taken the data from 1972 until now and taken the average over all these years. So now we know that US stocks have fared absolutely best over time. Real estate has done very well. And funny enough, the stocks from the rest of the world has done well too. But now let's get to the point of this video. How do we outperform the S&P 500 and still be fairly diversified and without never having to look at our portfolio again? That's the goal here. Let's look at what I have chosen. And yes, there are a ton of other ETFs to do just the same, but I will leave that up to you and your risk profile to choose some other or extras to work with. The point I'm trying to make here is that you can outperform the S&P 500 with various ETFs without any more risk and actually even less risk. The mix I have chosen suits most people's risk profile very well and still gives around 2 to 3% more returns than the S&P 500 and 2 to 3% over, let's say, 20 years. That's a lot. Remember, it's compounding. And I get it. The S&P 500 has a large, well-known companies in it, and yes, they do great. But they also get hit very hard when the market turns. The ETFs people like are usually SPY or WOO, SPY, VOO, and they're being traded heavily every day. So they have the problem like everyone else. Money is being poured in and money is being pulled out, always at the wrong time. That's the problem with ETFs. People pull their money out of the ETF exactly when they should have been putting more in, and vice versa. So we know we need a high degree of stocks, or at least I have put this portfolio together like that. Jack Bogle used to say that you should have your age as a percentage of bonds in your portfolio. And if you think of the long term, I think he was actually right. A lot can happen in, let's say, 40, 50 years. And when you get closer to retirement or old age, you will probably not like if your entire portfolio goes down 20, 40% and stays down for 5 to 10 years. This is the time where you need to use your profits. That's why Jack says you need some stable bonds to offset that risk. But I would argue that people watching this video are not about to retire for at least 30 years and are still in the building wealth phase and not in the preservation phase. So, stocks it is. Quiz time! So now we know what asset class has performed well the last 14, 15 years. Now it's time to look into the sectors. Which sector has performed well in the last, let's say, 20 years, despite crashes and such? Wrong guess. It's real estate, consumer staples, healthcare, and communication services. A useful indicator helping determine which sector, or actually which stock, will likely fall the least or the most in a bear market is something called beta. Beta is a number that measures individual stock and sector volatility relative to the overall stock market. Stocks or sectors with a beta less than 1 have historically been less volatile than the S&P 500, while those with a beta higher than 1 have been more volatile than the S&P 500. That means sectors with a beta less than 1 typically fall less in a bear market, while those with a beta greater than 1 typically fall more than the S&P 500 in a bear market. Now let's go ETF hunting. I would like to create a portfolio which will both withstand the inevitable recessions and will grow when the economy is booming. So I would like to have the following. I would like to have some growth. Here I would argue technology and healthcare, just as we saw before, those two will probably do very well. These are to capture the high growth periods and with a little bit extra stability from the large companies in them. And healthcare, I believe, is just going to get bigger with the ever larger population of older people. For the tech, I choose Vanguard's Information Technology ETF, ticker VGT. Since 2004, it has returned almost 13% compounded annual growth. This equals to, if you had started with $10,000, it would have become $86,500 in 18 years. That's around 765% gains. Amazing. Just remember there's also a small expense. It has an expense ratio of 0.10%, which is high compared to a SPY, but you gotta notice the gains are so much higher, around 4% more gains every year. Beta is 1.15. Some would choose the QQQ instead, but performance is better from the VGT fund and the expense ratio is half and dividend is also better. Okay, tech and healthcare. So now we need some healthcare. For healthcare, I choose Vanguard's healthcare ticker, VHT. And since 2004, it has returned 10.60 compounded annual growth. Remember, it's compound annual growth. This equals to, if you invested 10,000, it would have become almost 60,000. That's around 500% gains. It also has an expense ratio of 0.10%. And beta is 0.74. Remember, when the beta is less than 1, it will be less volatile than the S&P 500, so when the market gets hit, this one will do better. Okay, so we got the growth covered. Now I want some cyclicals. I want something that's stable and something that will work when the economy is both booming and not booming. So here I go for consumer staples and consumer discretionary, and especially these two ETFs. Vanguard Consumer Staples ETF, ticker VDC. Consumer staples is the stuff that people need to buy no matter what happens with the economy. These are the basic necessities we all need to have. Toilet paper, everything like that. Since 2004, it has returned almost 10% compounded annual growth, which equals $10,000 would have become about $53,000. That's almost 434% gain. This one is not the best performing consumer staples, but it has one of the lowest expense ratios with 0.10%. And that offsets the extra 0.30 gain like ETFs like IYK has. Beta is 0.57. In the end of the video, we're going to take a little bit of a look at why the expense ratio is so important and why I actually look at it. Even though it sounds like a small amount, 0.5, 0.10%, it'll be a lot in the long run, but I'm going to save that for the end of the video. Vanguard Consumer Discretionary ETF, ticker VCR. Funny ticker, huh? What is consumer discretionary? Well, it's the stuff that people buy because they have the money. Or actually, some don't have the money, but buy anyway. It's the stuff that you don't absolutely need, but it's very nice to have. See what I did there? I have usually two sides of the coin. One is up when the economy is booming, and the other is the opposite. When the economy is booming, people tend to buy nice stuff. Since 2004, it has returned 10.46% compounded annual growth, equals again to the initial 10,000, would have become almost 58,000. That's almost 580% gains. Expense ratio is Vanguard's usually low, 0.10%. Beta is 1.40. Now we need some real estate. And again, to capture the gains that should come regularly and only get hit when the housing market is bad. And it's usually not bad for a long time. So real estate is for when high-tech growth is not going very well and we still need to perform better than the S&P 500. Here I go for the Vanguard Real Estate ETF, ticker VNQ. And remember, REITs usually pay a good dividend too, and VNQ is no different, almost 3% dividend yield. Since 2004, it has returned 7.32% compounded annual growth. Again, 10,000 initially invested would have become almost 35,000. Expense ratio is 0.12 and beta is 0.98. Okay, now what? What are we missing? Well, I would either go for some emerging markets or maybe the more safe US small caps. Remember, they're number 2 of the best performers. Again, I turn to Vanguard, and instead of using the Russell 2000 ETF, VTWO, I use the normal Vanguard small cap ticker, VB. When subtracting the fee, it has performed the same as the small cap growth ETF, so that's the one I choose. Since 2004, it has returned 8.65% compounded annual growth. Again, 10,000 would have become almost 43,000. Expense ratio is 0.05. Beta is 1.14. Now that we have collected a pretty okay portfolio, let's look at how that portfolio would have performed if we bought it back in 2004. Now we can play around with the weighting of each ETF and what will also be what is your risk-reward scenario. So I'm just going to test out a few. Here I'm going with my test 1, portfolio 1. Oh, and by the way, I'm using one of my best tools I like. It's called Portfolio Visualiser. I'm going to leave a link to it in the comments. It's a fantastic site when looking at stocks and ETFs and how they performed over time. Can only recommend it. And it's a free version, so knock yourself out. You can do a lot of backtesting there. I will do a video on how to use it later, but it's really, really good tool. Okay, here's my portfolio 1 and how it has performed since 2004. As I mentioned before, VGT, Vanguard Information Technology, VHT, Vanguard Healthcare, VDC, Vanguard Consumer Staples, VCR, Consumer Discretionary, VNQ, Real Estate, and the VB Small Cap ETF. 20%, 20, 15, 15, 15, 15. Actually, myself, I would like to be a little bit more exposed to the information technology, so I'm going to try that later. This portfolio would have given you a nice 1.42% more than the S&P 500 every year. Not over all the time, every year, compounded annual growth. So, if you invested 10,000 here instead of the S&P, you would have had an extra $11,732 and your max drawdown would have been 3.8% lower. Now let's think about our timeline here. I would need to have this portfolio around 20 years, and in those 20 years, I would suggest that growth, innovation, and healthcare will be doing very well, so I would bump those up. Real estate will probably struggle in the next 3 to 5 years, so I'll mark that down. And I also think consumer discretionary will go down a little. So, as we saw before, we had a compound annual growth of 10.38%, while the S&P 500 had 8.96? So let's take the other one and see what happens. So we're bumping the Vanguard Information Technology ETF up to 25%. And we're bumping the healthcare up to 25%. We're going to leave the consumer staples at 15%. We're going to put the discretionary at 10%. And we're going to put real estate at 10%. And we'll leave the small caps at 15%. Well, again, remember, this is past performance. If we look back, that portfolio would have outperformed the S&P with about 1.71% every year, giving a $10,000 investment from 2004 to now to almost 60,000. That's 500% gains in 18 years. Usually you would expect a 10% gain in 10 years. So 500% in 18 years, that's pretty darn good. And if my guess is right, this is going to perform very well in the future. Okay, 1.71%. That doesn't sound like much. But what could that amount to if you were to invest over, let's say, 35 years? Well, here I tried using the S&P 500 with initial investment of 10,000. monthly contribution of 200 over 35 years, and with those 8.96% that the S&P has returned. Yes, baby, you would have had $714,571. That's a lot of money. And if you look at the curve, you can see, yes, you deposited a lot of money, but most of the money is the cost of the compound interest. Now, let's look at the portfolio number 2. What would that have looked like? Same initial investment, same monthly contribution, same period, but now with a little bit better yield, 1.71 extra than the S&P. And what do you know? 1.1 million, a little bit over 1.1 million. That's amazing, right? That tiny extra 1.71% every year for 35 years, that would have given you an extra $392,306, almost $400,000 more. That's why it's important to just get that little bit of extra. And with this portfolio that we put together, we outperform the S&P 500 with just a little bit, but that little bit is enough to make us almost 400,000 extra. Okay, now that I hopefully planted an idea in your head, you can play around with that great free tool, the Portfolio Visualizer, a link in the description down below, and find some ETFs that you would consider using instead. And hopefully you'll find the ones that match your age, timeline, risk tolerance, and how you want to perform. And that's actually very important. As Jack, may he rest in peace, always said, remember to look ahead and know when to switch your portfolio around. Let's hear some more wisdom from Jack.
Some investors are clearly using ETFs as trading vehicles, but what about advisors who seem to be building portfolios consisting of ETFs and they're kind of using them as long-term building blocks? That isn't a negative exercise, right?
Anything that involves trading of mutual funds, or for that matter, trading in stocks, is a negative by definition. All traders capture the market return before cost. They're obviously equal after cost because they're trading with one another. And so the more you trade, the less your return the less return you earn relative to the market. I know why people can't understand this. Because when you're buying technology stocks, somebody else is, I hope you're sitting down for this, Christine, somebody else is selling them. And so it's basically it's a closed relative return matter among all investors in any given class of stocks. So your advisor or you may be being able to beat the system for a while, but you're not going to beat it forever. So I hope I don't get myself into too much trouble here, but I am opposed to any significant amount of trading. Just because it costs money.
Right. But for advisors who are building buy and hold portfolios that happen to consist of ETFs, that's okay, right?
Sure.
Yeah.
And if you look at Betterment, for example, you'll see their portfolios are laced with Vanguard 500, Vanguard Total Stock Market Index Fund, and some of the others. They do not have high turnover. So I think they're doing the right thing.
So let's just take a quick look at that with the expenses I told you about. What happens if one index fund, one ETF, has a higher expense ratio than the other? Well, I'm going to use this small calculator called Expense Ratio Calculator. I will leave a link for it in the description. And here we take one fund that has an expense ratio of 0.05% and a fund that has an expense ratio of 0.1%. The initial investment is $10,000, annual addition is $5,000, and we expect to get 10% return. I set the duration to 40 years just to prove the point, and let's see what happens. Oh my God. Investment 1, it will cost, the fees will be $38,000. Investment 2 is $75,000. That's amazing. So you're actually paying $37,457 more using the ETF with an expense ratio of 0.1%. So 0.1% can actually be $75,000. That's a lot. That's why you have to take expense ratios into consideration and not only look at the returns, but also look at the cost. And that's one of the reasons I chosen almost only Vanguard funds when I choose funds, because Vanguard is very well known to have the smallest fees of them all. And fees, as you saw, really matter. If you got any value from this video, please give it a like, as it helps others find the video, and maybe even subscribe. I promise you it's free. And if just one little nugget of advice helps you out, that's time well spent. Remember, the more you learn, the more you earn. See you in the next video. Bye!
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the night inning. There ain't no point in resisting.